Hello and welcome to our first webinar since we were all asked to stay at home. My name is Kimberly Prey. I'm the partner at Catalyst Law along with Kate Kilberg, who is also with us, just not in video currently.
Hello.
Hi, Kate.
Hello.
We have Andy Furrow with Beneficial State Bank and Craig Hill with Beneficial State Bank. They've been wonderful to work with. Catalyst is in process of applying for the Paycheck Protection Program loan, and we've worked through a lot of details with them over the last few days. And so they're going to start with just a slide deck, an overview, and just walk through kind of what they're seeing, what their application process is going to look like when their portal opens. And then we have some calculations to share, just a demo of, how to calculate from your payroll, what's needed for the application. And then we'll just open it up to Q&A because I think a lot of people have a lot of questions about what's going on. There's a sense of urgency, and so we want to address that for you as best we can.
Well, awesome. Again, my name is Craig Hill. I'm a Vice President and Client Treasury Manager at Beneficial State Bank. And be looking forward to running through a few of your questions, kind of separating out the different loan offerings that are out there right now, both the EIDL and the Paycheck Protection Program loans are out there. And Jimmy, can you present for this one for us for that slide deck? Or does it need to be me? See.
It's downloaded, Craig. It's downloaded. It's being downloaded on the side of the screen.
Got it. Okay. All right. So first things first. This is what we know and what we don't. I did this presentation on Thursday of last week for the B Corp community here in Portland. And suffice to say, with how many moving pieces there are, so much has changed during that time. We've been trying to keep this slide deck live, but it's important to recognize that this has been a fluid situation all the way up until as recently as Friday, and that we're still evolving a lot of our understanding around this today as an industry. So on page 2, there's some definitions that are in here of this slide deck. And the first one really is trying to define a couple things for folks who may not have heard of it before. The CARES Act, which is referred to a lot, or the Coronavirus Aid, Relief, and Economic Security Act. It's a really large bill that's passed the largest ever stimulus package in the history of the United States at $2.2 trillion in aid and support. And it did include a $349 billion provision for small business loans through the SBA. And the SBA, because anytime you use an acronym, you should explain it, is the Small Business Administration, and it is part of the federal government. And they support small businesses and entrepreneurs, helping them get loan options and support when loans are otherwise difficult to obtain. So there are 2 different loan products that you should be aware of right now that exist. There's the EIDL and the PPP. And the EIDL stands for Economic Injury Disaster Loan, and the PPP is the Paycheck Protection Program loan. They both involve the SBA to some degree, though they differ significantly in what they're offered. Both can be obtained by businesses, meaning one does not preclude the other. And the other one can be forgiven, but the EIDL forgiveness is far less than the PPP provisions would be. So first things first, on the EIDL side, businesses actually apply directly through the Small Business Administration, and they're meant for working capital. You must be in an area deemed by the SBA to experiencing an economic disaster, which fortunately, it doesn't matter where you're listening from. If you're here in the United States, you are in an area qualifying as an economic disaster area. The loans are up for $2 million and they're used for working capital. They can be used on a broad range of issues, but they need to be related to your business's slowdown related to COVID-19, which isn't a super difficult case to make at this point in time. It is a repayable loan, and they have rates of 3.75% for businesses and 2.75% for nonprofits. Those are not negotiable. Those are the rates. The repayment terms and structure of the loan are actually done by the SBA during the economic injury loan underwriting. And they're not all of them are approved. They are subject to the underwriting, but $10,000 of that advance for that loan goes to every business that applies no matter what within 3 days of the application. And if the loan application isn't approved, that advance does not need to be repaid. It is forgiven. So we're seeing a lot of businesses apply for it strictly because it comes with $10,000, but not every loan that you apply for will be approved. Moving on to the next one, where most of the interest is happening for now, is the Paycheck Protection Program. The PPP loans are bank originated, not SBA originated, so you need to work with the bank to get these loans. There are non-bank SBA lenders out there, and the lists are online for both that can originate and underwrite them, but it's not directly through the SBA, just the guarantee. The loan size is based off payroll costs from the prior year, which could be either prior year, as in quarter 2 to quarter 2, April 1st, 2019 to March 31st, 2020, or January 1, 19 to December 31st, 19. But the proceeds must be used to retain your payroll and staff over the next 8 weeks. The terms are 100% guaranteed by the SBA, so there are no personal guarantees of any of the owners, and all of the loan terms are the same for everyone. They are 1% and no loan fee charged to the borrower at all. The program opened for applications for businesses and nonprofits starting last Friday, or 3 days ago, nominally, and it will go through June 30th or until the $349 billion pool runs out, whichever is sooner. However, the loans are 100% forgivable. That's the piece on this side. It doesn't mean they will be forgiven, but they are eligible for loan forgiveness for up to 100% of the loan. A lot of banks like Beneficial State have been slower to release our application process for these loans, specifically because we want to help folks understand what is eligible for forgiveness and what is not. We don't want people applying for money that they feel like is totally going to be, all I have to do is spend it on payroll and I'm fine. It'll be forgiven. It's a little more complicated than that, but it can be eligible for forgiveness. You need to use the loan proceeds predominantly to cover payroll costs, and they cannot exceed more than 25% of that total loan on mortgage interest, rent, or utilities or other working capital, or you risk losing the full forgiveness of the package. And finally, employee compensation levels must be maintained for months prior to the COVID-19 outbreak to what they are as of June 30th. They need to be very similar to those numbers. Otherwise, you risk losing the forgiveness eligibility. And there's a couple things on this slide deck that could say that an amount that's to be determined by the SBA can reduce your amount of risk or forgiveness eligible. So you need to maintain your payroll and staff from the loan date forward to June 30th. And if you decrease your salaries and wages of employees making over $100,000 or under $100,000 a year by more than 25%, that's also a grounds for potential forgiveness loss. Employees making over $100,000 a year are not, you could adjust their salaries down to $100,000 from whatever they're making with no penalty. It's just employees under $100,000 that have protections in place. And if you do not rehire all your full-time employees laid off to COVID-19 by June 30th, some of the loan proceeds may be required to be repaid over that 2-year repayment schedule. So there is a comparison sheet that's in here between the two of these. I encourage you to get familiar with at least the difference between the two of them. They're both important tools, and when understood in collection with one another, they could help a lot of businesses weather some pretty rocky times. And you can get both, remember that, but you have to use them on separate costs. Otherwise, you jeopardize the PPP's forgiveness provisions. We'd say as the last tips in the slides, a lot of things that Andy and I will talk about from a banker perspective is continue to read about it, continue to understand it. Calculate your payroll costs, work with your banker, work with slides that are out there to help folks calculate your payroll costs, which Kate and Kimberly we're going to talk about here in a minute. Talk to your banker as soon as possible if you can. If you don't have a banker, explore finding a banker. It's really important to have someone who could be on your team. And stay positive, lean into your community for support. We talk about this as B Corps. Values are not luxuries when times are good. They're essentials when times are tough. So lean in, let's work together and find ways that we can help support people. That's kind of what I have to say. Let's start.
Okay, thank you. So I'm going to upload on the handouts another handout that's from the U.S. Chamber of Commerce. That is a useful resource, just showing how to calculate those payroll dollars in accordance with the rules. And And then maybe Andy and Craig, you want to just talk through kind of what your bank is doing, what the current status is, and then maybe we can go into some of the nitty-gritty details of the actual loan application process.
Sounds great.
Okay. All right, it looked like Andy jumped off. So, Craig, do you want to just talk a little bit about what's going on, what the current status is, and then kind of what you're seeing from a banker's perspective, so we know what you're dealing with.
Yeah. So, as you might expect, there's Andy. As you might expect, when people hear about economic relief being passed by the federal government, there's a lot of interest in having access to those funds, especially as you hear of other businesses in your industry or type accessing those funds. So we at banks are seeing a lot of interest from different folks. We've also seen that the interim rules that the SBA released on what banks are supposed to use as guidelines did not come out until 7 p.m. Eastern time on Thursday night. And we were supposed to start lending at 8 a.m. Eastern time on Friday. It's created a really untenable situation for banks to try to balance customer risk and understanding, because we always say you should never sign a document that you don't understand what you're signing. That's good legal advice. And as bankers, as fiduciaries, we're expected to make sure we're acting in our customers' best interests at all times. So if we don't understand what you're signing, there's no way you can understand what you're signing. So we've been trying to help folks go through the process of understanding what is eligible for forgiveness up front, and then that way help them structure the right loan size for them and what's eligible as part of payroll costs, because it's not just as simple as this is what I pay people, those are my payroll costs. There's certain things that you may not think of that are eligible, and certain things you need to be aware of that make it from being so simple. Andy, you want to elaborate on some of that?
Yeah, I'd say it's an interesting time to be a banker, because banking is a very, very highly regulated industry, and we appreciate the urgency of the program. We like the program, but it has put us in a little bit of a bind, in the sense that money laundering and compliance laws apply. We're still held accountable to that. There's still loan docs that need to be pulled. So we're still going through a lot of the same framework that we normally would with any other kind of, at least a conventional loan. I know this is through an SBA program, but in the end, it'll look like any other kind of commercial lending. So it's going to be a little clunky. I mean, it does feel like an Oklahoma land rush, as one of my clients said, in the sense that they say, first come, first serve until the money runs out. Now, we are hearing even the president and people in Congress saying, if the money runs out, we'll find more money. But there's still a legitimate urgency for business, obviously. The sooner we can get businesses, the sooner that they can keep employees on payroll, that they can weather the storm of the next 8 weeks or so. So we're cognizant of that, and we're pretty fired up about that. But we found when the loans are rushed, that there's been mistakes. I mean, the EIDL program is a prime example. They had to pull down all the applications and reboot it and start over. With the PPP program, about half my clients downloaded the form on probably Thursday, and it looks different by Friday. So already the application is outdated. So it's clunky. It's a little challenging for us to work in this environment at times. We're not even really sure at this point how many loans have been approved. We know there's a bunch of applicants that have been submitted, because we're hearing that from banks. But we really don't know who's getting it yet. There hasn't been a lot of publicity about that. There's still a lot of money, so I know there's a bit of a concern that if you're not jumping on this early, that you're going to miss out on the opportunity. But we feel more comfortable being careful, and the reason we do that is, even though the applicants have been submitted, themselves are not complete, it's quite possible that they'll get stuck, and it's quite possible they'll come back. And so we are being careful, and I know it's a little challenging for the people that we're working with, because we're eager as anybody to get those out there. But I'm hearing large banks are not necessarily the easiest to work with right now. So I'm proud to work for Nimble Bank, where it's pretty easy to get a hold of us. We're engaged 24/7, and think that in the end, I think we'll be quite proud of what we've accomplished here. Bank of America on Friday said, "Don't have a loan with us. Doesn't matter if you have a deposit relationship with us. We can't help you." Chase said, "Jump on our system," but the system went down. Wells Fargo, we're done with the program. We submitted 10 billion in applications. We're capped. You're on your. Some banks don't have a PA program, so they're not a good fit. Some simply do not have the bandwidth or the capacity to handle it. So, as a community bank, we're pretty mindful of taking care of not just our clients, but any business in our market that is looking for help, assistance in applying for the PPP loan. And we will provide the opportunity for you to do that through us. And there's a lot of great stories with many banks who are doing that. But it is a challenging environment because there is such a sense of urgency. There's not a lot of clarity in some of the guidelines. There's a lot of confusion going on. So the best thing what Craig and I have found is to just be very, very proactive on a one-on-one basis. It's nice that we can put this information out there holistically, but everybody kind of has a unique scenario. So this is a good test for how good relationship you have with a bank. If you have a good relationship with your bank now, you have a banker that you work with. I've always had people say to me, "Oh, we're not that complicated. We don't need a relationship manager per se. We don't need to have those dialogues strategically." And this is a great example why it's good if you do have that relationship with a banker. This is a great reason why you should.
Mm-hmm. Yeah, absolutely. So I'm going to hop off. Kate, why don't you hop on once I'm off, and then we can get going with kind of a demonstration of just a hypothetical small business and how to calculate those payroll costs. I'm going to figure out how to log off.
Okay, and here I am. Hi, everybody. If you go onto the handouts link to the side, I believe we are, or I will now, actually, it looks like I'm going to do now. I'm going to share our PPP calculations template. And this is what we used to calculate our numbers for our loan. And I've kind of made this I've kind of templatized this. And I just want to walk through with you and hope that this will help you. I'm going to open it up here, take a look. Okay, and so I have it up, and I just want to sort of show you how this spreadsheet works. This is not an official form in any way. This is something that we just used internally at Catalyst. Andy and Craig at Beneficial liked the way it looked. They said it was easy to follow, so we're sharing this so that each of you can organize your information in the same way. So on the first tab over at the left where it says Interim Final Rule Calculation, that's where you're actually coming up with your numbers. And if you leave the spreadsheet the way it is, most of these numbers, except for the cell that's highlighted in yellow there, are going to calculate automatically from the second and third tab. So what you're going to need to do if you use this spreadsheet is go under the second tab, aggregate payroll costs. And then for each of your employees at the top, you can put their names in at the top of the column, and then you'll go through your payroll reports, and you should be able to find these amounts on your payroll reports for each employee. So if you can pull your payroll reports for the entire period that we're looking at, which is April 2019 through March 2020, you should be able to pull these numbers from your payroll reports. And if you'll see on the left side there, so we have healthcare coverage, retirement contributions, parking, And then the Oregon deduction. So what you want to be careful to do, and I understand that there's some confusion about whether you can put the employer paid federal taxes in there or not. We did not. We chose not to. You can obviously take a different tack if you want, but we have just included the employer side costs on unemployment, TriMet, and Oregon worker benefit for the employer. I think there was a question, I think I saw a question about what other types of fringe benefits you could put in there, life insurance, et cetera. So the way I read the interim final rule, it's pretty broad. I mean, it sort of says any compensation, any benefits. So I would say go ahead and put those in. I think that, you know, that's a legally defensible position, is to add in all of those types of fringe benefits and costs that you have per employee. So once you've pulled all of those numbers from your payroll reports here on tab 2 in aggregate payroll costs, the formulas, again, if you leave the formulas the way they are on the spreadsheet, that will total it, they'll total themselves up, and they'll go in and fill in line 2 on the first tab. And then the very third tab where it says subtract compensation over 100,000. So in my example here, employee 4 and employee 5 were the only ones with compensation over 100,000. So we put them on the subtract compensation page. And again, the formulas are in there. You'll just subtract out the 100,000, add up the total subtraction, and then that also carries over to that front page where we're doing the main calculation. And then after that, the math is fairly easy. So you divide by 12, multiply by 2.5. The only thing that's a little bit confusing is if you had an EIDL loan prior to COVID-19, basically. I mean, if you had an EIDL loan for some reason, and Craig, correct me if I'm wrong, then you would add that amount into this shaded yellow box. I'm guessing that for most people, that's not the case, but if it is the case for you, then you add in the EIDL loan on that line, and then you'll get your final amount. In this example, we would be looking for a loan of $89,000. So that's just an extra tool that we're sharing with you. We hope it makes calculating the numbers easier. And then I think I'm going to back off again. I'm going to hop off again, let Kimberly back on. We've got some great questions coming up alongside the chat. And so I think what I will do is with voice, I will read the questions, and then Kimberly, Craig, and Andy, if you could just answer them as we go through them. So I'm going to hop off here on the video.
Yeah, and if I could say too, Kate, I think one of the main reasons to do the spreadsheet the way you did it was it makes the banker who looks at it, it makes it real clear for them to understand where the numbers are coming from. Because there's, you know, when I first started doing reviews over the weekend, I was getting these huge payroll reports, and it was really hard for me to track the math. So what I really liked about Catalyst did was it was really simple for me, and most bankers are not going to be payroll experts, and for us to be able to look at where the math comes from, check the math, that really helped the application go through a lot smoother.
Kimberly, do you mind? I see Glenn's question was the first in order here about submitting the PPP and the difference between 2.5 months used for calculation versus 8 weeks we could use for payroll and have forgiven. The reasoning behind that one that we've seen at the bank is that there are some provisions in the PPP allowing for you to spend it on non-payroll related costs. And the original rubric they came up with was 8 weeks of payroll costs, plus then about a quarter of the overall funding being able to be used for other things that are mortgage interest, loans, other expenses that you may have that aren't payroll. So how they came up with that was taking 8 weeks of payroll and then multiplying it by each one of those pay periods basically by a quarter, which would be another half of 2% of the 2 times, right? So 8 pay periods. And then if you took another quarter of that, it would be times 0.5. So that's how they came up with the number of 2.5 times. But just make sure you don't spend more than 25% on non-payroll activities, because it's not meant to be spent more than 25% of the overall loan on things that aren't payroll costs.
So, and just to clarify, Kate again. So if you don't have utilities or rent or something like that, you might consider taking out a smaller loan. You do adjust your math to what you think you'll actually use for payroll.
The one concern that we have is that if 8 weeks from now, it's after getting your proceeds, it's not everything's forgivable. It's a low interest rate, but it's only a 2-year repayment term right now. So, if it's okay in good faith if you felt like you had a certain number that you applied for, but come to find out you laid off 3 employees over those 8 weeks just because you just didn't have need for them, and it didn't make sense for overhead to keep them on payroll. Granted, you can allocate some of that to the interest expense on term loans, the utilities, the rent, so that could offset it. But if you miss by say a couple $100,000, it's you made a good faith effort, so you didn't do anything wrong. But now you have a 2-year term to pay that back, and it can be pretty aggressive. So you don't want to miss by much. You want to be as careful as you can, and you want to keep really, really good record of those proceeds and how you spend them. So when that forgivable review comes up 8 weeks or so after you get the proceeds of the money, you want to be really careful that you can justify those proceeds went to the place they were supposed to go, so that you can take advantage of the forgivable portion of it.
Yeah, and that's a really, we've heard, and Craig maybe in your presentation last week, that it would be a great best practice to keep the loan money actually in a separate bank account, so that you can actually show when those funds are dispersed and track, do some tracking, so that if that was questioned at the forgiveness stage, that you'd be able to show the bank statements and when those transfers happen. So always be thinking about the documentation.
Okay, I'm going to jump to the next question, which says, is the bar on the EIDL higher than on the PPP in terms of certifying that government action has limited normal operations versus certifying that current economic activity loan is necessary to support ongoing operations? So I think the question there is do you have to show more hardship for the EIDL than you do for the payroll protection?
The main barrier that we've seen with EIDLs when folks are going for them is that they are underwritten by the SBA. So there has to be cash flow and other pieces that are going into the underwriting of that with an expectation that you're going to repay it. The SBA does not want to get in the business of making loans that people can't afford to repay, right? Because they would just give the money as a grant like they're doing through the PPP section rather than through the EIDL. And there are some folks who qualified for an EIDL a couple weeks before the PPP passed. And there's actually an element of the PPP where you could take out the PPP loan to be larger than the payroll protection program loan and pay off the EIDLs if the payroll protection program was what you were taking, if the equivalent is why you were taking out the EIDL in the first place, which is to keep paying your staff to keep them going. So we've seen some folks that you get kind of stuck in the middle. But the SBA has a very rigorous way of doing things. It's almost like a language in and of itself that people get set up and learn how to do. Whereas the PPP, it's goofy to even call it an SBA program because it's unlike anything else the SBA does. So the main barrier is it's not difficult to demonstrate you've been affected by coronavirus slowdowns. Most folks can just say, here's my March 20 or my March 19 numbers. Here are my March 2020 numbers. I have the same number of employees and I spend the same amount on marketing, where like that, you could tell pretty simply that you're being affected by this slowdown. Or if you're a gym, for example, it's pretty easy to say, yeah, the government forced my business to be closed. I can't be open right now. But the bigger bar for those ones is that the EIDL, if you can't, the reason they do underwrite is if you don't qualify for the loan, as in they don't think you're going to be able to repay it, you may not qualify for it at all. And that's the difference with some of the PPP. Has absolutely nothing to do with your cash flow, absolutely nothing to do with your viability as a business, simply that you could demonstrate that you've experienced harm and that you need help with your payroll.
Okay, so another question about the PPP program. Do you have a sense about when the funding might happen and how that timing relates to the timing of allowable expenses?
Depends on your bank. Andy, you want to take that one?
Well, I still look for evidence that people are getting money. I haven't seen a lot of that yet. There are a lot of applicants going in. I mean, there's just going to be hundreds of thousands of applicants through in a matter of a few days. I don't. I mean, there isn't a credit aspect too, which is really useful. That means it doesn't really have to go through a heck of a lot of scrutiny. I did definitely on the front end for banks. There's still anti-money laundering and the normal compliance stuff, but there'll be fraud. I mean, we know there will be a lot of fraud in this program just because it's meant to be a firehouse to put out a barrel fire. I mean, the intent is that just go crazy. We're going to get as much money out as fast as we can, as many people as we can. Let the chips fall where they may. We'll figure out the details later. And that seems appropriate. In a crisis, I'm totally supportive of that kind of program. But it's still going to look like a bank loan. I mean, there's still going to be loan docs, still going to be compliance, documentation that needs to be verified. So if I submitted an application today, we could probably get a response we would expect within a few days. Then we'd have to draw docs. We could do e-signatures, so nobody actually has to physically move around. But there just isn't a lot of allegorical reference to money getting out there yet. But I wouldn't be surprised if applicants that went in on Friday will start seeing checks this week, provided that the loan applications that were rushed out on Friday, and again, nothing went through on Saturday and Sunday, so we're measuring either Friday or today at this point. It provided that the applications were complete, and provided that the compliance was the compliance issues and the compliance documentation provided by banks should be able to get them out for e-signatures pretty quickly. And then it's apparently the banks can go to we're lending our own money, but we can go to the SBA regularly, and they will continue to wire money to us to backstop anything we're putting out there.
I will say too, just really quickly, that the SBA loan docs in particular, that this piece about the funding with the PPP program is that you have to certify that your payroll as of 2/15 and 6/30 are going to look similar. So if you do get a loan right now and it funds this week and you have 8 weeks in which to use it, that's still just the first week of June. And then you're going to have to make it through June 30th with your payroll numbers looking like that to be eligible for forgiveness. So if you feel like you're going to get a loan too soon, and then you're going to be stuck for a month where you're having to float a bunch of payroll costs if we're not out of the woods yet in terms of the stay-at-home orders being finished or other pieces, I can't guarantee you'd have to find the money to stay afloat for that extra few weeks, which is why if this program is going to have a backstop and the government's going to float it further and going to put more money, it may actually behoove folks to wait a couple weeks to see what this is going to look like. And if they expect as of June 1st that business is going to be totally business as normal again. I'd hate for folks to take out this money, spend it for 8 weeks, and then realize they're still up a creek and this isn't going to be over yet. And now you have a loan that may not be forgiven because you can't afford to pay your people.
Oh, that's scary stuff. I'm gonna keep going on. So we've got about next question from Scott, which is a question about force majeure clauses. And I'm actually gonna skip that one because our intention is to do another webinar later this week where we will be talking more about legal related questions. I'm gonna the time with Craig and Andy just for the PPP. We will get out the programs. We will get out the date and time for the legal related questions as soon as we possibly can. That will be later this week. Okay, I'm going to go down to Cynthia's question. Cynthia says, Bank of America is requiring a credit card or lending relationship to submit PPP applications. The SBC guidance says that banks should not screen lenders. Is this a conflict of interest, and is there anything we can do about it?
Now you try to find another bank. Not to be too flippant, but it's there's a lot of pieces in the banking industry here that when there's a lack of guidance and they're seeing the money go out the door, what is the natural tendency when banks have loans out to folks is to make sure they're paying their borrowers the money so that they can continue to repay their own loans. I'm not saying it's the right move. I'm not saying it's any of these things, but you can understand why people are going in the face of interest. Are you taking care of somebody who's been a borrower of yours for a few years? Are you taking care of somebody who needs the loan right now? And it's easier to put a face to a name with somebody. Those organizations might do it. But I, as far as legally goes, I mean, heck, we didn't even have the rules on this stuff till Thursday night to start looking at it. It's really tough to make a decision whether or not we want to just call that bad faith. Which we could just say on its face, we don't think it's the right way to do things. And we're not limiting our program to only customers, but there is a recognition that it's going to be easier to do this for customers because we have a relationship with them and know all of the parties. We know that we have the signers' information. We have these account holders' social security numbers and information. It'll be easier for us to do these loans than it would be for someone we've never met before.
Great.
Andy, do you feel similar? I know you.
Yeah, I think Bank of America made effectively a business decision that generated some PR for them, which is kind of like what Craig said. The devil that they knew. These were clients that they already had the compliance docs on file. They were able to make credit determinations whether the PPP applicant was credit worthy, and the net result for them was they got a lot of applicants out fast, and so they looked good for 24 hours at least. But they kept changing the rules too. I mean, you couldn't be a lending relationship. Then it could. It was a business card, but not a corporate card. But then it was a corporate card and a business card, and there's a lot of people that are getting assurances by banks who are still waiting. I mean, hey, your applicant, you've got a verification number, you're in the queue. Don't call us, we'll call you. These are the things I'm. And it's not very reassuring, and that's challenging. But some of it is it's kind of a tough place for a bank to be in. But at the same time, everybody should get their money. The making the determinations to go with just your premium clients first it's kind of a big bank way of thinking. I used to work for a big bank, and I know that's how they think. That's in their DNA. But yeah, it's a legitimate frustration, and hopefully this is an opportunity for smaller banks to approach businesses and say, maybe we're going to be a better fit, especially for small businesses, than a big bank like Bank of America, who's really a lot more interested in their investment banking business and their big commercial banking, middle market, corporate stuff. That's always been a better fit for them. And I've worked for a big bank. I know that as you get further down market to smaller businesses, you don't get the same experience that their bigger clients do.
Okay, and then we talked about, so then the next question is for PPP, what fringe costs are allowed when calculating payroll, healthcare workers, life insurance, short-term disability, what is and what isn't allowed. And again, we're just interpreting the interim final rule here, which basically says payment for the provision of employee benefits. And so it doesn't really go into a whole lot more detail. So my argument would be, if I were arguing this case, that, those are all employee benefits and their costs to the employer, and you should be able to count them. I don't know if any of the others that have.
And there is a list. So if you look at the interim final rule on page 10, there's a list under paragraph F, what qualifies as payroll costs. And there was some confusion earlier. So I think something came out before Thursday's interim final rule that indicated that 1099 contractors would be included as a payroll cost for employers. That has been walked back, and this interim final rule makes it clear that independent contractors, because they have their own businesses or they're sole proprietors, that they are considered not payroll cost qualified. So if you were thinking that your independent contractors would be included, that's no longer the case, and the program is going to be opened up for sole practitioners and other self-employed people, sole proprietors, on Friday. So they have to wait another week after the program opened for businesses and nonprofit organizations. And I just,
Kimberly, on page 11 of that same document of the same guidance, it does list some of the exclusions as well.
Yeah.
So 10 and 11 are really, really relevant in that 31-page document.
I would also throw out there for folks about salary when you're thinking about the $100,000 cap. One of the other questions that a lot of banks are having and we're seeing out in this direction is whether or not the $100,000 cap applies to all benefits for an employee. So that if somebody makes $100,000 a year and then their healthcare and 401k contributions and everything takes them to $120,000, technically salary is $100,000. That's the cap. That's $100,000 salary. The fringe benefits that are associated with that are not necessarily considered salary. They're considered benefits. And there's kind of two different ways you could cut that. And banks are making their own determinations on how that is. That if somebody makes $110,000 a year and has $20,000 in additional benefits, can you count their payroll costs as $120,000 because only $10,000 of the salary is over $100,000? And it's hard to say. And we've been looking at both numbers, and right now just saying that we think it's defensible to say payroll costs over $100,000 employee are still allowed. We think that's still a defensible position for folks to be taking. That if you have a 4% 401k match and make $100,000 and they have healthcare that's 10% of their salary, that's $114,000. That would be their payroll cost, even if it's capping the salary at $100,000. So again, I keep telling folks, I wish we had more information because I really do. I hate having to make judgments that maybe that the SBA comes back, and I've said this a couple times, the IRS is going to be really short up for cash this year for what our funded pieces are because we're cutting back so much on the economy about what's happening. I'd hate for them to go looking through every application with the fine-tooth comb for these PPP loans and find that certain people are counting something over, make a later ruling, and then all of a sudden be like, no, you have to repay that. We're not going to forgive it. It's not meant to be a cautionary or to like scare you away, but more to just breathe in that sense of caution that we're trying to use as a bank to make sure folks are understanding what they're getting into and try to provide some best guidance before you jump in.
yeah, thanks, Greg.
All right. Next question for EIDL. What happens to the $10,000 advance if the loan is approved? Are there circumstances where it can still be forgiven?
My understanding is that 10 grand's forgiven, it's just forgiven. Like it's basically, they don't want to punish people who get the loan by not giving, by saying you actually have to pay back the 10 grand too. But that's just my understanding. The SBA, the first day that the EIDLs were really open for folks, they had wait times that were in the weeks on the phone. They were saying your call will be answered in 148 hours or something like that. It was ridiculous. But now they've staffed up their call center to be a lot more. We've heard that the wait time is somewhere between half an hour and 3 hours, which is still a long time, but it's not nearly as long as weeks. And there's a lot of developing best practice guidance out there for that. But our understanding is no, the $10,000 is $10,000 if you could demonstrate your injury, your economic injury.
Right. And it's my understanding that if you get a PPP loan after you have had an EIDL loan, that with a $10,000 advance, so just something through the act, so that would only apply to a very small subsection of folks that jumped on the EIDL very quickly after the CARES Act was passed, that $10,000 of your PPP money would then be, your PPP loan would be reduced by the $10,000 advance that you received through the EIDL. Is that your understanding too, Craig?
It is.
Yeah. Okay.
Yeah, and I think the EIDL program it's been in place a long time. I mean, if your town gets hit by a tornado, I think this is the loan package that SBA usually offers those communities. The concern we had with this program was that they're used to the applicants being just small subsections, and the people who got hit by a hurricane or a flood, to have the entire country eligible to at least apply was a little overwhelming for them early on.
Okay. So the next question is, when you're looking at paid leave that accrued for you, and I will just say, I don't know that is like many things definitively in the interim final rule. What we did at Catalyst when we were doing is we only reflected what we actually paid. I don't know if Craig or Andy, if you have thoughts on that.
Yeah, there's some there are some things on page 11 that talk about paid sick leave or paid leaves, even to the point related to COVID. You know, I don't have it in front of me, and even then, I'm not sure you're going to get clarity reading it yourself. But I do highly recommend looking at that guidance and looking at page 11 there. There is some mention to some of that in there.
Okay. Next question is, can I add subcontractors? So we talked about that. Generally, if they are an independent contractor, they should apply for themselves, and that payroll and those loans will open up on Friday. Oh, and I skipped one. So Christine asked, are we looking at April 1st to March 1st or end of the month for the counting period? And where do I see this?
It's saying either one. For a lot of folks, using 2019 is an easier guide, right? Because your books are completed for the year. It's easier to document things that happened last year. There's a lot of full year payroll statements and things you can get from your payroll provider. Although you can use April 1st, 2019 to March 31st, 2020, if you want to. And some folks gave raises after the first of the year, maybe hired some new staff that would make your numbers look slightly larger and more reflective of your current situation. There's also an exemption for seasonal businesses that's in the rules about your seasonality of certain things that seem higher or lower. If your busiest period of the year is January to June, that's different than folks whose busiest time of the year is, say, July to December. It's just you're not going to be as impacted by this program if you're a seasonal delivery worker for the holidays, or versus where if you're in tax prep right now, this is your busiest time of year, and delaying the tax season by, for when folks have to do for taxes until July 15th, that could really impact a lot of CPAs and accountants.
Yeah, I think the challenge is, what are your staffing levels now? I mean, because there's a lot of clearly retail that even if you'd like to hire people back, you don't have anything for them to do, or you're a manufacturer and you can't put people safely on a production line and keep social distancing to the degree that you feel you need to. So many times it's going to really come down to, okay, if this is going to be tied to my labor force, going with the current labor force may be more relevant than 2019. But we found sometimes people are like, well, my 2020 Q1 payroll report isn't going to come out for 2 more weeks. And in that sense, I'm recommending not waiting. I'm saying, well, go with good faith effort to figure out what payroll numbers are. Ideally, you could call your payroll rep, and they can provide you trailing 12 numbers up through March. And we're beginning to see, I think pretty much yesterday, starting to see some payroll processors doing really nice comprehensive reports that account for PPP applicants. So they're putting in and the right stuff, and they're excluding the right stuff, and they're giving you really clear presentations. And again, really the SBA is going to make the determination whether you've done your math right. It's probably the banker, and so anything you can do to help the banker means your application gets to the SBA quicker. And so that would be my recommendation. Make it as simple and as clear and as documented as you can now. And then, of course, we'll go through this document process when we forgivable portion of it later, and the rules will probably be different by then. But right now, we really just want applicants to get to SBA as fast as possible. So the simpler it's presented, the more accurate it is, the more likely you will get the application approved in the process quicker. And also that the numbers that you're representing will, for the most part, be forgivable. That's the hope. So if you go with a 2019 numbers and your labor force is quite a bit bigger than it is right now, you're probably going to find that there'll be some portion of that loan that will not be forgivable at the time that that comes up for review.
Right. And so, Craig, can you just heard that you are both taking the 2019 numbers as well as, as an alternate to the last 12 months, which would be April through March.
Yeah, guidance allows both. It's specific. And in fact, if you look at the application itself on page 3, it will tell you that both of those are fine.
Okay, great. Thanks. I know that's been a little bit of a source of confusion.
Yeah, because it's not either. It's but or it's not one or the other. It's either, and that doesn't help anybody for clarity.
Right. Right. The rule says one thing, the act says another, and yeah, that's really helpful.
That's happened a few times, unfortunately.
Okay. Margaret asks, please restate the point, and just so everybody feels taken care of, we will stay on, or at least I will stay on, as long as we get until we can get everybody's questions answered. So we can go past the 4 o'clock point if you can, and try to get all your questions answered. So the next question is from Margaret, which says, please restate the point that forgiveness of the loans is only if the payroll from mid-February 2020 is maintained for 8 weeks post-loan. We laid off nearly 80 people mid-March and do not foresee rehiring them, or the majority of them, until the state is lifted. So how would that affect the application?
So if you're going to use those payrolls numbers of the people you've laid off as the justification for your payroll costs, then you need to bring them back off unemployment and use those payroll numbers on those employees, not on other activities. Because if you don't, and you use it to keep your company afloat in other ways, that is just going to become a loan, basically, because you didn't use it for payroll costs. So what we tell folks is, I totally get, like, laying people off was a very rational move over the past month and change. It was the only real option for folks when you own a restaurant and they forced you to close or stay at home. There's no way you could keep everybody, you could just keep paying people. Restaurant margins are not that large. However, if you're going to get this PPP loan, not an economic injury disaster loan, if you're going to get a PPP loan, it's meant to preserve your payroll. And in many ways, the reason they're doing it is to lower the unemployment numbers that are out there by keeping people employed. And the unemployment offices are absolutely swamped. And I'm hearing folks, calling 50 times a day, trying to get a hold of their unemployment folks and not having any luck. What this is meant to do is bring those people back on payroll. Now, you have 8 weeks from the date of your loan to use the PPP funds. That's the idea, is over 8 weeks. So if your 8 weeks do not coincide before the end of the act, which they're measuring forgiveness as of June 30th in many ways, that's the idea, is that when you get this loan, you have 8 weeks, but then as of June 30th is when they might do the measurement of your payroll from what it was before February 15th to June 30th being the comparison date. So if you bring people back just to lay them back off in June again because they're still under stay at home, this loan actually didn't do you many favors. It might actually just become more debt that you have to pay because it's not supposed to be used to pay unemployment benefits.
Yeah, I mean, one concern that I have, I've been doing this about 25 years, and oftentimes when I see businesses get in trouble, it's that they didn't cut overhead fast enough. And, many times you think you're getting a purchase order that doesn't come in, or that you lost the business that you were anticipating having. And, layoffs are hard. I mean, it's a rational decision to want to keep your staff, especially if it's highly experienced staff, it's talent that's going to be hard to replace. I do worry a little bit about the PPP undermining rational business decisions about reducing overhead. So if you've cut labor by 80%, that sounds like a rational business decision. Bringing back people because of the PPP loan has a lot of pitfalls. One is that, is it the safest thing for your staff? Do you have enough for them to do? And if not, what are you going to do with that labor? And is it just going to delay at a time when maybe people want a little bit more certainty on what their job's going to look like? I have some clients who find it now hard to compete against the unemployment payouts, which are quite a bit higher. So it may be hard for them to even rehire, even if they wanted to. So there's a lot that goes into those decisions. But it's also possible that 8-9 weeks from now will be a second phase of this. And if we can keep this going for, say, 4 months or 5 months, maybe normalcy will rush back. Maybe we'll have one of those V-curve economies, and then it's good to have your labor ready to roll and have your people ready to take on those orders when we can all get back to normalcy again. So it's a tough business decision, and I do have some concerns about where we stand right now and all this uncertainty and how to make a rational business decision.
Well, and so in this case that is asking about where they laid off 80 people in mid-March and don't foresee rehiring them, sounds like the PPP program is maybe not the best fit. Would EIDL be better, or even just a regular SBA loan, or what? Are there other options out there for her?
Yeah, I think the EIDL might be a better fit. I mean, because that goes through the SBA, I'm not as familiar with. Like Craig said earlier, I mean, they're quite a bit more rigorous. SBA loans are always more rigorous. We in fact, at the bank, we have experts who will work alongside us to make sure that we are following all of the rules. There's usually quite a few that don't look the same as normal conventional commercial bank lending. So if you go through that process, I think you're going to find it is a lot more exhaustive and a lot longer process, but it might be a better fit. And the end result is we want to keep businesses alive, and that could be a great way to do it.
Okay. All right. The next question is, what if an employee quit but was not laid off?
Presentation around this that don't include that employee in your payroll costs then, if you're not expecting to hire an equivalent FTE when it comes back. Because if you base your payroll costs off 15 employees versus 16, when you fired that 16th person or they quit, base your payroll costs off of exempting that person out of your calculations. It may seem a bit goofy, but it's also, you don't want to be relying on having to hire another person after this is done to ensure that that amount was forgiven.
However, you can rehire a different person. So all that the forgiveness part of the loan application, when you're all done with the 8 weeks, is going to be looking at are the number of employees, not who those employees were. So if someone quits on your team after you've submitted the application, then you do need to replace that person on the team, or there will be some adjustment on the forgiveness portion of the loan.
Great.
Okay, next question. This is from Monica. I do not have employees. It is just me and an occasional contractor. I work with the schools, and I'm assuming I will not be able to work again until September. I only need to cover my own income, honor my contract, and a few expenses, so less than $15,000. Which loan would you recommend, if any? I've applied for unemployment, but I haven't received a response.
First off, Monica, I'm sorry. It's not a fun spot to be in. You would be then, if you don't have any employees, if you're paying yourself like an owner dividend, or you're self-employed, or you have a 1099 employee, you would be under the one that opens this Friday, the same PPP program. You'd still be eligible for it as of Friday, is our understanding, and which is also making us think that, assuming there's still money left in the pool for those folks, and if not, that the government would step in and make sure there was. It's not particularly fair to have it not be available for an entire class of employee. If that happens, the PPP loan may be your friend if you can demonstrate that you're still working at the end of that and you don't have any other employees you're trying to cover. But if not, that's the idea, is it's meant to keep businesses afloat until things can return to normal. And if you plan on still doing this as of June 30th, and this is still going to be what you're doing, the risk for a no employee employer or self-employed individual seems a lot lower for forgiveness than it would for a business that has to demonstrate bringing that payroll back.
Okay. Next question for Glenn is, can we apply for the $10,000 EIDL and get free $10,000?
Keep in mind, it's a good faith application. You're probably gonna have to see it through. I agree, it's by all accounts money, but you can't just say, I changed my mind, never mind. I don't think that would work. I'm not sure, but I don't think that's quite gonna work. You'd have to probably see it all the way through.
Okay. From Carla, you go and then when the PPP loan comes through, can they be rehired?
Yes. Most definitely. And that's often the point with some of these loans, is to try to relieve the unemployment rolls and get people back to a steady paycheck. And that's kind of the point. So if you laid people off and things, you include them in your calculations prior to February 15th, there's some different pieces you could do, but yes, that you can absolutely rehire them. And that's some of the design of the program itself.
Okay, and then from Eileen, I heard on a different webinar that the EIDL still has standard SBA requirement that you need to prove that you can't access credit elsewhere, and also that it requires a personal guarantee. Is this true?
Yes, it definitely is. The SBA, you are owing the government money. Like that's what it is if you could qualify for the loan. And that's the one where you don't want to take that money out. I mean, the government is the last person you want to owe things to in a lot of ways, because they're harder to discharge. There's harder things to get around.
And I want to make sure I say something else that's, I think, important, which is, if you have conventional lending with a bank right now, this is a really good time. And I know we're all going to be really busy, but to make sure that you have clarity on your loan, like your line of credit being renewed, because banks are going to look at your financial performance historically, and right now most people are still demonstrating financials that are pre-COVID. It's been my advice to my clients to do whatever we can to get credit approved and get loans, conventional loans, just normal lending, done as soon as possible, just because there isn't a lot of clarity from banks right now how we're going to normalize financial performance for companies after the COVID and after what undoubtedly will be recession, a couple quarters of recession probably, and you should also be asking your bank what the position is on covenants, for instance. Are they going to be open to waiving covenants? Are they going to be open to sort of what business fundamentals are pre-COVID, post-COVID, and determine that any financial headwinds that were encountered during the COVID period, which hopefully won't be too long, but is that so non-recurring that they're willing to just look past that quarter, those 2 quarters? I think it's a really important time, if you have conventional credit, to be having those conversations with your banker.
Great, thanks, Andy. So Megan says, should guaranteed payments to partners of a partnership with employees and thus payroll be included in the business's PPP application, or should they apply with sole proprietors, self-employed individuals on the 10th? I will just, and Andy and Craig can tell us if we did this wrong, but so that's the situation that Kimberly and I are in. We're the owners and we take distributions. And we did include ourselves on our application, and that is because there's a separate rule out there. Go on the treasury.gov website that talks about the affiliation rules, and we read those rules to allow the exact situation you're asking about. So partner owners to be considered with the company.
Yeah, and I think this is a real gray area. There's a lot of gray areas because this was rolled out so quickly. And so, I think this is an area where you just have to, make a decision one way or the other. Are we going to do one application, which seems like the most efficient thing to do under the circumstances, or are you going to read it, a lot more narrowly and make 2 applications? I think we'll be seeing additional guidance, but at this point in the process, nobody really has definitive guidance.
Yeah, it's not real clear. I mean, I think if you're in that gray area, it's probably okay to ask for a little bit more. But my recommendation would be, because you don't know if everything's going to be forgivable, kind of park that money and sort of protect it, just in case it's not forgivable. If you don't spend it, you can pay it back right away, or you could take the 2-year loan and bleed it off over 2 years. But if it is a gray area, I'm also completely supportive as much money as you can. You're making a good faith estimate based on some really awkward rules. Make sure that you have, so you're not stuck with a loan you don't really want because you can't get enough of it forgiven.
Okay, so we have from Eileen. I thought the period that would be looked at for forgiveness was the 8 weeks effective the date of the loan, not back to February 15th. What's the relationship between those two periods?
You are correct, Eileen. It is the 8 weeks after the date of the loan. The February 15th piece that they're doing for a lot of things is demonstrating that that was the first time that we are declaring that there's any COVID-related layoffs or effects happening. So there's a lot of discussion around February 15th as a date that there shouldn't have been any business impact yet as of 2/15. So it could go back to the employees as of that date in some ways, and then look at it as of June 30th, which is the forecasted as part of this bill. If it's optimistic or not, who's to say? But that would be the determined end period of this program. So comparing those dates, even though it needs to be used within 8 weeks of the loan date, and that is as of the loan funding date, is my understanding, not the loan approval date. So if you get an approval today and it funds on Friday, the loan date would be as of the date of the docs are signed and funded.
Great. And there's a follow-up question a little bit lower that I'm going to bump up because I think it's related to this one. So Christine asked, what is the date of the loan? Submission, approval, or I would add is the date of funding. What's the date of the loan?
Yeah, that's the date that you sign the documents, would be what it is. And the date you sign the documents, most banks don't love having you sign documents and then funding days later. It's something where we'll try to send out documents, especially if it's with e-signing and other pieces. In the documents, it'll tell us how to disperse. It's like when buying a house, right? That there's going to be an agreement. They want to lock it on a certain day and have that happen. So what I'm imagining will be the case here for many, many, many banks is they'll have you e-sign things. And if it were Friday, that's Friday the 10th. And they would then be funding that loan to you on the date that the docs and everything are all signed, which would be the 10th as well, which means you'd have 8 weeks from April 10th. That would be the date of the loan.
So then we have a note from Carla that says B of A has changed the rule that you only have to have a checking account. So just making that point. And then
as of 2/15.
As of 2/15.
Yeah, true. That's just,
so then we've got a question about what is the interest rate for the EIDL?
It is 3.75% for businesses and 2.75% for nonprofits. And that there is no wiggle room on that, is just what it is. However, the payment structure will look different depending on how they underwrite your company.
And then we've got a question from Monica that says, is there a difference opening up Friday to specific to self-employed people? So, and then just sort of extrapolating on that is there a difference between the PPP application, et cetera, for the self-employed folks on April 10th, or is it just we're pushing back the date that they can apply?
The application that's out there right now will be the same application. Again, everything in this program has changed at some point, so who knows? But the application that's out there right now does have boxes that says self-employed, contractor, S-corp. There's all sorts of different boxes you could check, which makes me think if there are boxes you could check that you can't apply for yet, it'll be the same loan application on Friday. Granted, they changed the loan application after the loan application was live to accept loans this Friday, so your mileage may vary.
Okay, I think we've gotten through all of the chat questions. Is there any other sort of guidance or advice, sort of closing words that you would want to tell our folks who are watching? Craig and Andy?
Yeah, I think one important point is that this doesn't cost you anything. There are no fees, and I think there's been some rumors that there are people out there offering this program with fees. So those are the shy. Those are not the legit people. There's no guarantees involved, and there's no collateral involved. So it should be smooth and easy. I know the guidance has been. I know everybody's asking for it at the same time, but by and large, I think we'll look back at this as one of the successes of this. Of how we responded to this crisis. I think this is a great program. Craig and I are very excited about executing on it. So it's not an overnight thing for us to be able to get the money out and get it in people's hands. But it's not for lack of effort. Everybody is on board, is pretty excited about it, and we know once we deliver on it, and everybody gets their money, that it probably will play a big role in getting a quick recovery for this economy.
And we had one more question here at the end. I'm still not clear on whether federal taxes for an employee can be counted in payroll calculations, and then just the employer side. So we chose not to include the federal taxes, and we did just include the employer side. But I would be interested to hear what Andy and Craig had to say.
I re-reviewed page 11 again on the guidance today, and it does say exclude federal taxes, Medicare, Social Security, railroad retirement tax, which I'm not really familiar. But what's confusing is that some of the payroll providers are excluding it and some are not, and I don't know how to answer why that's so, because literally got a summary statement from ADP from one client today, one from a different client today, and they use different math for the same report. So I don't know how to explain that. I think if you make a good faith effort, I don't think anybody's going to hold that against you. I do think it's important that you are in line with your banker. Maybe your banker's indifferent, but maybe your banker says, no, we're gonna say no federal taxes. You just make sure that you're not doing anything that's going to delay your application from getting through. But again, if you feel like you've asked for too much and you think there might be a risk that it's not forgivable, try not to spend that money so that you have that available to repay that at the end.
That's great advice. I'm seeing more questions saying AICPA is suggesting using gross payroll, so that would include the costs that are then withheld from employees for their portion.
Yeah, we've seen that for sure. That the AICPA thing is floating around a lot whenever somebody's trying to justify a higher loan amount, and we're like, look, that guidance is out there. The guidance in the rules, the interim rules, is saying not. So what we're trying to go off of is the interim rules are the ones that are going to be applied to banks in our mind, and we don't want to set people up for failure. So if it's that desperately important for you to have the higher loan amount, even at the risk that it may not be forgiven, then that's kind of your call. And as long as we walk you through that and your eyes are open to those possibilities, I just want folks to always remember that just because you can have it and it may be out there and you could make a case for it, is also that somebody could make the case the other direction, that something was out there and in the guidance that says you couldn't do that and you're going to have to repay it. And I understand there's a lot of folks out there really desperate to keep things floating and keep this stuff going. Totally get it. And that every little bit helps, and it totally can. But don't just go for the higher amount because you feel like you can go for it. Go for the amount that's going to help you get through the next 8 weeks and paying your employees the way that you're hoping to do so that you can stay afloat and hit this, when the stay-at-home orders are lifted and your business can thrive again.
So there's some additional questions on that topic. So just to be clear about what we did at Catalyst, so we did not include any federal taxes in our calculation for the loan, and we only included the employer side costs. So the portion that was withheld and paid on behalf of the employee, we did not include that in our loan calculations. The reason being, that's not really our cost, or at least that was the rationale we took, that's not really our cost. And I think that's consistent with what Craig is saying.
Yeah, it certainly is what I'm saying. And when we looked at it together over the weekend, I agreed with your math. I think that's the appropriate way to do it.
Okay. So I think we're at the end of the questions here. I will just say that you can reach either Andy and Craig at Beneficial. So if you go to beneficialstatebank.com and dial the main line, should they just ask for one of you if they have questions? Is that right?
Yeah, that should work. Yeah.
Okay.
They'll
And
find
same
me.
thing. Great. And same thing for Catalyst. You can go to our webpage, catalystlawllc.com, or you can call the office at 503-207-1711 and ask for me or Kimberly or any of our other attorneys. We are doing free 15-minute consults if you just have a few questions. And then we're offering a discounted half hour for $199. So you can ask a lawyer and get all your questions answered for $199. And then, as I mentioned earlier, we're going to be doing additional webinars on different topics over the next few weeks. So let us know if there's a topic that you have questions about. I know we had a question about force majeure earlier and contracts. That one we will do this week. But we're going to be doing our best to be putting out our knowledge to you so that we can be a best service as we can.
And I just want to add, Kate, that we are helping clients and other members of the community who are applying for these PPP loans. After going through the process ourselves, we feel like we have a pretty good handle on how to do that. And we have a great relationship with our bankers. Their portal is going to be opening up soon and taking applications from folks that they don't have banking relationships with as well, which is a great resource. So we'll be helping facilitate, and help in getting those applications in if you need it.
And I'm getting a message from our tech person that says that everyone will be getting a copy of the recording of this presentation. So if you missed something that we said or it wasn't quite clear, you can go back and rewatch it or listen to it and get the answer.
All right, thank you everyone, and definitely call and reach out for help. We're here to answer your questions and hopefully get this done for you and with you. Okay.
Thanks everybody. Stay safe, stay at home.